Welcome back to the Stuff About Money podcast. I am Erik Garcia, certified financial planner, along with my co-host Xavier Angel. Xavier, what's happening, man?
I'm doing good. How are you doing this morning, Erik?
Man, I'm good. Are you sure you're doing good? You paused. There was a pregnant pause when I said, "How are you doing this morning?"
I'm doing
Yeah.
great. Look, the weather isn't looking too good for us, but you know what? This weekend is supposed to be beautiful, so I'm
All right.
doing
Good.
good. No complaints
I'm
here.
glad to hear that. I'm glad to hear that. Well, this is actually a special episode. We're doing this in collaboration with another podcast, Financial Matters with Richard Oring. Rich is a good friend of ours. He's got a investment practice up in New Jersey, and we do a lot of work with Rich. Some of our listeners may have heard us talk about Rich. We build investment portfolios along with Rich. But the reason we're doing this show is we want to talk about the importance of collaboration between CPAs and financial advisors.
Right. We're going to be touching base on increasingly more important the ever-changing tax climate that we have right in here. The landscape for taxes is changing on a regular basis. And there's also a slew of COVID-19 relief for businesses and individuals out there that we're going to be touching on.
Yeah, so taxes are certainly complicated, and the reason also on the call we have a CPA with us that Rich is going to introduce here in a second. But the reason we're doing this in conjunction with Rich is because Rich used to own a tax practice. Rich, tell us a little bit about yourself and tell us a little bit about your current practice, and then if you can, introduce Doug for us.
Sure. So I got into business in 1999. I worked for a mid-sized accounting firm in New Jersey. There was 3 locations at one time. And my job there was to help grow the financial planning and the investment side of the practice. The problem is when you work for an accounting firm during tax season, leaving on a Thursday at 5:30 when everyone's working till 1 or 2 in the morning is kind of rude. So I had to learn how to do tax returns. So I was thrown in the fire, took courses on tax preparation. And before I knew it, I was pretty good at it. A couple of years later, I decided to, I was offered a partnership at that firm. I saw where they were going with some SEC audit work, and I just saw a conflict. And my partner and I, we bought our clients back. We started our own firm. Unfortunately, in 2009, my partner passed away. And a couple of years later, I actually sold my tax practice to Doug Ziegler, who's our guest today, our CPA. He works in our office. But one of the things I learned through that process is understanding taxes and financial planning investments go hand in hand. They affect each other.
Yeah.
So my practice is in Princeton, New Jersey. I'm the owner of New Century Financial Group. I started working at New Century Financial Group actually in 2002 when I spun off the tax practice to my own firm. And we've been growing mostly financial planning and investments since we started, with the focus on the tax planning going hand in hand. And Doug and I work very, very close together with the tax projections and the investments and how it falls into the 1040 or the business return. So at this time, why don't I introduce Doug Ziegler?
Yeah.
Doug, do you want to actually talk about yourself and a little bit about how you got into the business and where you are today and what you're looking for in clients wise?
Yeah, thank you, Rich. I'm very happy to be here, and thanks for the invite. Again, my name is Doug Ziegler, and I've been in the public accounting field for over 30 years. This is what I've done with small firms and regional firms, and then on my own. And the ideal client, I think, is someone who cares about their financial well-being, their tax return, and has some input on what they want to try to accomplish in both arenas.
Doug, Rich, right about now in our show, we ask all of our guests, what's one thing about money that you wish you would have known about 20 years ago? So I'm going to hand it over to you, Rich, first. Tell us, what is something that you wish you would have known 20 years ago?
Well, the one thing, everyone who knows me knows that I'm a serial hobbyist.
Yes.
So I like to go from one hobby to another hobby. And as you can imagine, hobbies can be expensive. This wasn't something I learned as an adult. This was like something I had my whole life as a kid. And I used to make a lot of money as a kid. I was an entrepreneur. I had a gutter cleaning business. I had a window cleaning business, snow shoveling. I worked at restaurants. So I made a lot of money, and I had really expensive hobbies back then. Back then, with RC cars, bicycles, I mean, you name it. I would go on vacations with my friends and so forth. And I look back and I go, wow, all that money I made, if I didn't spend it, how much money would I have had now accumulating? I know in your previous podcast, you talked about compound interest and how money can grow. That would have been a fortune. I might not have been working right now.
Rich, I've known you for I've known you for 7 years, and probably that 7 years worth of hobby spending, you could be retired by now, just in that 7 years. Forget as a kid.
So thank God for my wife. Every time I get a new hobby, yesterday I decided to buy a new pasta maker, and she always responds like, "I'm happy you bought this, but you're going to have to buy a new house because we're going to outgrow it." And that kind of scales me back, the fear of having to sell my house and buy another one. My wife is a very good controller of my hobbies.
So we're going to get you and your wife on a show about spending money without the other knowing, like what's the limit that you can spend before you can spend without permission from the other. That might help you. That might be the lesson here, is don't spend money unless my wife says it's okay.
Well, we used to have a deal that if it was less than 300, we didn't need permission.
Yeah.
So
I'm also going to send you a link for one of our previous ones with our guest, Felix Garcia. Felix talked about for every $5 he made, save $3 and spend $2.
That's it.
Yep.
All right, Doug. What's something about money? What's something about money you know today that you wish you would have known maybe 20 or 30 years ago?
Well, I'm going to expand on one of the points that Richard made, and that is, when I was in college, I learned about compounding interest, and that math class that we took, I was actually very good at. But the one thing I didn't do or realize at the time, because you're young, is that the compounding interest doesn't help you unless you actually save the money. So you have to save the money and invest the money in order for the compound interest to really give you a benefit. And here we are 30 years later, 30 years plus, and the time goes by so quick that the benefit of the compounding doesn't help unless, one, you put the money away, and two, you allow it to do what it's supposed to do.
Yeah, that's some serious wisdom there. I listened to a friend of mine podcast, and he said that he was talking about someone else, that you have to be so good at the basics, people think you're cutting edge. And I love what you two just shared about. I mean, y'all are successful. I mean, all of us on this call are successful. Y'all have successful financial planning businesses, a successful CPA firm. And the thing that you wish you would have known about money is so basic and so simple. Spend less than you make and save. So basic.
So Xavier, you talked about the story with Felix growing up in the business. My father used to always say, you have to pay yourself just like a bill. So when he would meet with clients, he was a CPA and a financial advisor. He would always go to new clients and say, look, if I take $5 out of your wallet, would you miss it? Clients say no. And he would go up to 10, 20, 30. And then he would set up a DCA, dollar cost average, where you're automatically purchasing an investment every month. This way, you might be buying it on a high, a low, but it's an average. But it's a forced discipline saving. And then what the client didn't know is, in about 6 months, he's going to call them and say, did you notice anything? Did you have to change your lifestyle? No? Good. Let's raise it.
Yeah,
I like
and
that.
Before they know it,
that's good.
Yep. He said, pay yourself like a bill. You know your electric bill is due on this day. If you know that the investment company is going to take money from your checking account on this day, it's just like a bill, and you know you better have the money in the account.
So we can end the show right now.
New for today, right?
Yeah, we can end the show right now. If you finally learned something,
go ahead.
yeah. we can end the show right now, and there's probably I think our listeners will take away a lot from what's been said already. But unfortunately, it is not that simple. As Xavier let in, like, taxes are complicated. The tax code is increasingly more complicated. Programs are getting more and more complicated. Here in Louisiana, in New Orleans, 2020 tax returns were just due on February 15th. 2020, tax returns were just finally due because of all the extensions, and taxes get complicated. So yeah, I think it's really important that there is collaboration between planners and CPAs for several reasons. Rich, just as you said, you're paying your CPA typically to look backwards. You're paying your CPA to prepare taxes, to give an accounting for something that happened in the past. Some CPAs will strategize, and I think most CPAs given the opportunity, would love to strategize more. But the reality is they're constantly having to look back. And that's where the planner comes in. There's three ways that I think planners and CPAs can collaborate. Number one is just in the minimization of capital gains taxes. Rich, you talked a little bit about that already. Number two, identify missed opportunities on tax returns. And then number three, increase tax efficiency in your estate plan. So, Doug and Rich, what are your thoughts on the impact or the importance of planners and CPAs collaborating? Doug, why don't you go first?
I think the most important aspect of that question is communication. Erik, you had mentioned earlier that CPAs generally prepare tax returns in a looking past format, and that they take the information that's happened over the past year and they put it on a tax return, and that's generally what they're paid to do. When you collaborate with a planner, hopefully you've had a conversation with that person during the year. And what I like to try and do is not destroy the plan that the planner has put forth with the client by telling the planner you have to create capital gains because I have capital losses that I want to use, or I don't want any more qualified dividends because it's creating more income tax in certain areas that I don't want, rather than giving the planner some options on how to streamline the portfolio and accomplish two things at the same time, which could be a lower tax rate and maybe a higher return on your investment in the portfolio.
Yeah, I mean, I had an image of driving a car, right? An accountant or CPA is going to be primarily looking in the rearview mirror, and the planner is typically looking forward. And it really helps if the person going forward and the person looking behind are collaborating and talking to each other. Rich, what about you? Where do you see maybe some importance?
I'm just thinking about the last 2 weeks in my office. I had a financial planning client, just retired. He's now going to be using Doug for his tax return. His accountant just retired. And I brought Doug in, and, I'm doing the planning on this side. I can't know every single tax code. It's impossible. So I'm not going to act like a CPA and put myself out there. I can give recommendations, but there's times where I need to bring an expert in. So being able to pull the expert in pays off. This particular client has 529 plans, and he was paying 100% of the college through the 529 plan and was losing out on some credits. Doug, do you want to clarify exactly what you recommended? Do you remember this?
Yeah, I remember the conversation we had with the client, and if I remember correctly, he had at least one or both of his children in college at the time, and in order to take the credits, you have to have dollars that are paid out of pocket rather than from a 529 deferral plan. And the magic number is $4,000. If you've paid that out of pocket, then you qualify for the credits. So you have no incentive to pay 100% out of the 529. As long as you pay at least $4,000 for those expenses, you get the credit.
And how much was the credit the client was going to get?
$2,500
per child.
Per child.
So that's $5,000. That's not a deduction. That's a credit. That means dollar for dollar off your tax liability. So that's big right there alone. Client saving $5,000 for the next year. Couldn't go backwards. His other accountant didn't recommend that. But going forward, client just made $5,000 in savings with credits he never knew about because he had money saved in the 529. He did what he was supposed to do and save for college. Never thought of, maybe just pay a few thousand out of pocket and I get this $5,000 back.
That's huge.
Just the other humongous.
Rich.
And honestly, with all these credits and stuff, as advisors, we know about them, but we may not think of that when we're doing the retirement projections.
So I've got to imagine that this collaboration between the planner and the CPA, this is an ongoing thing. You guys aren't just sitting there and talking once or twice a year. You're constantly keeping in touch and updating the client's plan. Is that accurate?
I can tell you right now on a regular basis, I'm always updating Doug with our clients on, hey, this client's turning 72. They're going to be taking an RMD out. You better adjust the estimates. They're selling I have to take some capital gains just letting you know, I'll run my projections. I'll send it to him. He'll compare them. Just the other day, I recommended a client paying off their mortgage. And I know this year they had a lot of medical expenses, but next year they're not. So talking to Doug about the standard deduction compared to the itemized deduction, because we're going to lose the mortgage interest. And we were able to realize there was no harm by paying off the mortgage. So just that collaboration with our professional recommendations and then pass it through the person who has to prepare the return and knows the tax code inside and out.
Wow. That is powerful. So you started talking about some strategies. So let's go ahead and move into a couple different strategies that are out there that you do collaboration on. So this first question, Rich, I'm going to throw it over to you. So tell us about some of the ways that as a planner, you're collaborating on taxation of investments. So if you can start there for us, talk about that.
Man, I could talk all day about that, but I know we don't have enough time.
We're not going to let you.
So let's go with something different. Let's go something with maybe someone didn't hear first about the 0% capital gains rate or qualified dividends rate. So a lot of planning strategies I have is if someone's retiring and there's going to be a year where we can delay Social Security or IRA distributions, I look at the taxable account, the non-qualified accounts. So those are monies you put after tax contributions. And I look at the gains, because if I have to sell assets to get the income, the cheapest place might be from appreciated assets, which everyone's always thinking long-term gains, 15% is going to cost me money. Well, that might not be the case when you have a year of very little income. We might want to try to maximize, even more than we need. We might want to reset the basis on appreciated assets, knowing that when we are taking our IRA distributions, our Social Security and so forth, and we need to supplement it with the non-qualified assets, in the future, it might even come out less because we reset the basis by selling it at a 0% tax liability and then reinvesting it.
All right, let me pause you.
So
let me pause you real quick here, Rich, because there's a lot of stuff here. One of the things that we like to do on stuff about money they didn't teach you in school is break things down in simple, as pedestrian language as possible. And there's a couple terms there you use that we kind of throw around the financial industry that might not be common words. So one of the words was appreciated assets. So that's like anything, like you're talking about specifically a stock, a mutual fund that has grown in value, right?
That's correct.
Okay.
You bought Microsoft for $5 and it's worth $200 today.
Okay. And then the second term you use that I think is not a common one is basis. Explain that real quick.
Basis is what you bought it for. And then it gets a little bit more complicated. If you bought a stock for $100, that's your basis. If it pays $5 dividend and that dividend's reinvested, it could be a mutual fund too. If you reinvest the dividend, you pay tax on that year on that dividend, and then it increases your basis. So now your basis would be, let's say $10 plus the $5 dividend is $15. Okay. And you sell it for $20, there's a $5 gain.
Okay, so yeah, that's what I was going to ask. Is the gain is the difference between the basis, what you bought it for or paid for it, and then what you sold it for, and you're paying taxes of some variation on that difference, on that growth.
Correct. Correct. Most people don't realize or they forget.
There was you just mentioned gain, and both of you guys talked about gain a little bit. So I want to throw this one over to Doug real quick, if he can explain the difference. Talk about short-term and long-term gains. What's the difference in that? Because that's a question that's been coming up often.
Currently, the IRS definition of that is 12 months. If it's more than 12 months, it's long-term. If it's less than 12 months, it's considered short-term. Those are the simplest explanations of that, and each term carries a different tax rate burden.
So 12 months meaning your holding period, like how long you own something before you sell it, correct?
Correct. Okay. Holding period.
So usually the short-term gains, so you bought a stock today, you held it for less than 12 months, it would be ordinary income, so whatever your marginal tax rate would be, and long-term gains for the average person, there's excess if you make over so much, but the average person, it would be 15%. So if you held an investment for 1 year, 1 day, it's 15%.
So this is kind of the beginning of your answer. You're talking about zero capital gains. You're talking about in non-retirement accounts. We call them non-qualified accounts. Is that there's a way, if your income is really, really low one year, and you're saying that happens often in maybe the first year of retirement, there's an opportunity maybe to go sell these investments in your non-retirement accounts that have grown maybe tremendously over the years that you haven't wanted to sell because you didn't want to have to pay the tax on it. So now there might be an opportunity to say, hey, look, we might be below the income threshold and pay 0% taxes on this gain. Is that what I'm hearing you say?
Yep. If it's a 12% tax bracket or lower, you can capture, because again, qualified dividends and long-term gains is at 15%. So below the 15%, if you're in a 12% bracket, you may not be able to do it all, but you may be able to take 50, 100, 200, working with Doug, we figure those numbers out. We do it all the time. Even an IRA distribution, I'll say, hey, Doug, I got to fill out this IRA distribution. The client wants tax withholding. I'm coming up with this number. What do you think? And he'll be like, you know what, Rich, you're not aware that he's not withholding money from his pension. Why don't you bring this to a 20% withholding to help a little bit? And the state in Pennsylvania, there's no tax on retirement distributions. Yeah. So we talk all the time, even for basic stuff like filling out forms for distribution.
Yeah, I think that's huge. And I think that, often, I think if you listen to our disclosure at the end of the show, your disclosure at the end of your show, one of the things that we say is we are not CPAs. We are not qualified to give tax advice. So to be able to lean on an expert or phone a friend, if you will, phone a friend who's an expert, who knows the client's case, knows the client's situation, to ask that question is invaluable. It's almost like,
Erik,
go ahead.
The funny thing is, when I used to have a tax practice and I was doing tax returns where I didn't do the investments, and then the client got a surprise at the end of the year for tax liability. Here's the best part about being a financial advisor. When a client owes money and it's the advisor's fault for not communicating, the tax preparer always gets blamed. They always get the blame. It's never us. Like the accountant can say, oh, your investment advisor made money. Okay, we made money. So we look great and you owe this money. But the funny part is, do you know how many times I've seen clients' returns where they took gains in the beginning of the year, they owe money, and then they lost those gains at the end of the year? Could you imagine starting out with $100,000, paying, it grows to 120, you sell to 20, you owe $3,000, and then that 120 goes to 90? That hurts.
Yeah, I've always said
that stings.
I tell my CPA all the time. I'm like, man, your job is impossible. I don't know how you function, because it's like the goalie for a soccer team, right? It doesn't matter if your defense broke down. Everyone looks at you and said, you should have stopped that, Doug. Doug, you need to reduce my taxes. It's on you, Doug. Blaming fingers on the poor CPAs. Doug, what's an area?
I think.
Go ahead, Xavier.
I was going to say, I think this leads in right to the next question for Doug. What are some areas that cause unnecessary expenses and costs to clients that could have been avoided if they had their CPA and their advisor collaborating?
I think the biggest one is not funding your 401k or your SEP plan or whatever retirement account that you have, because that causes multiple problems. One, you'll pay more in taxes because you're not deferring that income until your retirement. Two, the lost opportunity to earn money that you've put away for your retirement. And that amount is immeasurable. I can tell you what the tax is going to be because you didn't put money into a plan. But the fact that you didn't, and you had 10, 20, 30 years ahead of you for retirement, that amount is immeasurable. That's the biggest area that I've noticed.
Doug, saying that, I know you're aware of it because I think every other month you're referring me a client who needs a retirement plan set up for self-employed people. They start out their business, they're not making a lot of money, and then before they know it, they're making money, and you're calling me to come into your office to meet with the client to set up solo 401ks, SEP IRAs, whatever they need to get that tax deduction.
Doug, I'm actually surprised that was your response. I was expecting something more complicated or something something deeper or more hidden in the tax code in terms of the things that cause unnecessary costs. But it kind of goes back to maybe your original answer about something about money you now know. It's goes back to something as simple as just save. That so many people just aren't saving, taking advantage of that tax deferral that you mentioned. I'm curious to know how when you're sitting with a client, and let's say it's a client with a 401k, and they have a traditional 401k contribution versus a Roth 401k contribution. Is there anything like in your thinking process that might change whether you think they should do a traditional contribution versus a Roth contribution?
I think the short answer is yes, but back to your original premise, I try to keep it simple. It's never a bad decision to save money, never, no matter where you decide to put it. And I think the decision between Roth and a traditional IRA or even a non-deductible IRA is a complicated one. I actually had this conversation with a client of mine and Richard's yesterday, and we weigh the costs. We weigh the cost of not having a deduction because when you put it into a Roth, it's after tax and there is no deduction up front for it. We weigh the cost of the individual's age. What type of return do you think you're going to get on that Roth investment? We always weigh the cost of cash flow. In certain circumstances, you can put more money away if you choose a Roth provision because the criteria for your income limitations are higher than in a traditional format. So in some cases, the Roth may be your only avenue to save additional dollars. So it's always a personal one. It's always a complicated one, and one that I actually enjoy having the conversation with, because I'm always about planning for the future when I do a tax return, not just putting the numbers in for the past.
I'm just going to add one thing. That's where collaboration comes in, because I have the financial plan already set. Doug might be looking at the maximum tax deduction, but I can look at the future distribution and tax rates in the future. So yes, Doug can do that. He could probably knock that out in Excel, but why? I already have it. I already have the plan, making sure they can retirement in time. So when he's coming up with these conversations, a lot of time he already has the information in front of him. I'm going to print off a cash flow report or projected taxes for the future with RMDs and everything. So again, the collaboration between the two of us is very important to work with our clients efficiently.
Yeah, Doug, you said
Can one of you guys? We talked about what happens when we make those contributions, whether it's to the Roth portion of the 401k or the traditional. Tell us a little bit about what happens when you begin taking distributions, depending on which route you choose.
Well, from a tax perspective, I love having multiple buckets: a Roth bucket, a traditional bucket, a personal savings bucket, all types of different investment vehicles, because since the taxes a lot of times are different on each bucket, depending on what the client's needs are and what the client's other income may be, that may help us steer the decision as to which bucket to pull from and what the lowest impact of taxes may be. And also, when you collaborate with your planner, it allows them to take money from these different buckets without destroying the overall plan that they're trying to accomplish.
Man, that's so,
And I love
Doug,
that
as you're
example
saying
of the
that,
buckets.
yeah, as you're saying that, I'm thinking about, so often as investment advisors, we talk about diversification. You need stocks, international stocks, big stocks, small stocks, domestic stocks, bonds, right? But we forget so often that we need diversification across different types of accounts, the way taxes are applied. I'm going to tell you, when I sit down with a client and all their money is in a 401k and they're having to take out $50,000 for a required minimum distribution, and they have Social Security and a pension, then all of a sudden they're like, my income's 120,000, I'm not even working anymore, and they're just so limited in what they can do from a planning standpoint. It makes it challenging. So I love that idea of forward thinking of not just today, but we don't know what the tax code is going to be tomorrow, so let's give ourselves some flexibility for tomorrow. I like that.
Yeah, I think we all can agree that the tax rates probably are going to go up over time since we're at historically low tax rates. So if someone's in a high income job right now, yeah, you probably want to get the deductions. But again, this is where the planning comes in. If you're making 100,000 for the household, maybe you want to do a combination of the Roth and traditional. We try to maximize a bracket.
Yeah.
You want me to talk? It's probably a good thing to talk about just real quick,
Yeah,
Eric
go ahead.
Xavier.
Yeah,
Do you want to talk about maxing out brackets between IRA distributions or even funding a 401k, maybe doing part traditional and part Roth?
Yeah, I've been a huge fan of that for a number of years. There's two different traditional scenarios, and one is the retired individual who doesn't have a lot of income, but they have a lot of their money in a traditional IRA. If there's a certain amount of money between the zero bracket and the beginning of the next bracket, or tier one of the bracket, the 12% to the next tier, you have an opportunity to take money out of that account at 0% taxes or a very low tax bracket. You don't have to spend the money. You can just take it out of the IRA and put it in your savings account. And you can even keep it in a similar investment or the same mix from your investment standpoint. But you have an opportunity to take out that money without tax. And it's a great way of using the tax code to your advantage.
It's such a simple technique, but yet people miss it because I find people, they don't want to pay for a CPA. They want to go down to like the storefront tax preparer because they think they're going to save money. But sometimes when you hire a professional CPA who's seen, over 30 years of experience, multiple things going on with people's finances, they usually there's usually a return on that investment that you're paying them in terms of tax savings down the road.
So Eric, as Doug was talking, I was thinking about our practices. I know that all three of us, Xavier, Eric, and I, we had an initiative to really reach out to younger clients graduating college to get them on the right track. And a few of the clients I'm working with, you may not be making a lot of money your first job out of college, and there's something called and they all live at home. You graduate college, you're making $30,000 a year, and you're living at home to save some money. And we took advantage of IRA contributions this year because there's something called a saver's credit. You might get back 50, depending on how much money you make, it gets phased out, but you might put away $6,000 and get $3,000 back on a credit on your tax return because you're saving. That's big when you're making $30,000 a year.
Yeah, it goes,
okay. As long as you have that money to put it in there, it's great.
Yeah.
I
think anything we can do to incentivize savings is a good thing.
With several clients and their children over the last several weeks. Save. You're getting your first job. You're working at home, or you're living at home. Go ahead and put that money into those accounts. Begin to save and get those credits. So I think that is a great tool to begin to use and work with young individuals out there.
Doug, my kids know that you make money, you put money for savings, you give some to charity, and then you can spend some.
Yep.
That they've learned that at an early age, and as they earn money, they know that. And here's another deal we have with them. If it can't be gifts, if they make money, and I don't mean from a job, I'm talking about like raking leaves and stuff. If they deposit into a savings account, which can't be used to after college, I double it for them.
When can I set up my account with you?
When I can take you as a deduction.
Okay.
So I'm holding up a piggy bank here. For those of you watching on YouTube, you can see it, and it says donate, invest, save, spend. So this particular one has 2 slots for spend and save. My kids have one at the house. Now, this involves using cash, which we're kind of a cashless society. But, when my kids were younger, we tried to make it a point that they actually had physical dollars and change to be able to physically see, save, spend, donate, just to kind of reinforce those ideas in their mind. So I like how you talk about that.
So,
Rich.
Eric, 2 things. First off, your piggyback bank is empty. So we may want to talk about dollar cost averaging every month. Second thing is, what you may not know is,
it's hard, man.
In our office, when you first walk in, there's a box. We call it a tzedakah box in the Jewish religion, and it's charity box, and it has a little sign explaining what it is. And it's amazing. Every couple of months, I can open that and there'll be at least $100 in there. People drop 20s, 5s, 1s, change.
That's cool.
And then as our group in our office, we decide a local charity to donate that money to.
That's a great idea.
And all my children have those boxes in their room.
That's a great idea. I thought you were gonna say you had a jar in your like a cuss jar in your office. Every time someone dropped a cuss word, you got to put some money in it.
Well, it wouldn't be funded by me, but my staff, I would be retired again.
Yeah. Between your hobbies and your staff cussing, you'd be like Warren Buffett. One final question as we're coming to a close here, and we'll spend a little bit less time on this one. But Doug, what are some items that maybe as we're talking to our clients, particularly as we're here preparing for taxes, what are some ways that that have helped you in working with financial advisors in terms of maybe communication with clients, communication with you, and preparation for that engagement with the CPA with you?
Well, as I mentioned earlier, communication is always the key. And I have a quick little story. Back in March of 2020, when the market took that big dip, a lot of institutions had sold out of certain positions and bought back others. So they may have sold Coca-Cola and they bought back Pepsi. So their plan doesn't get destroyed, but they get to take the loss. And I had one client who was very wealthy, and they had generated $700,000 of capital gain losses due to this dip. Wow. Because after March, the market came back. So not only were their portfolios up and they were intact from a strategy standpoint, they also had $700,000 of possible gains to use. And I called up the advisor while I was doing the tax return, and I said, well, what is your plan with these losses? I would really like to see us utilize them somehow, because they don't do us any good sitting on the tax return, only be allowed to take $3,000 a year, because if you don't have gains to offset them, the IRS only allows you to carry $3,000 to your current tax return and the balance forward. And the advisor had told me, well, they're worth money because of the tax rate. And I said, well, they're really only worth money if you utilize them. If the client passes away tomorrow, they're worth nothing. So there should be a plan in place to do something with these losses. And I always preach balance. There has to be balance. There has to be a plan. Don't just do it for the sake of doing it. There has to be a method to your madness, a reasoning for why we're doing these things.
You know, I'm listening to Doug, and the first thing that comes to my mind is, wow, you know, Xavier, Erik, we do something right when we manage money. And maybe for a future podcast, that's something we should be talking about tax efficiency and tax strategies on what type of investments you have. What he just described was most likely stock ownership, actually owning the equities compared to a mutual fund. I mean, this is something in the future we should probably talk about.
That's my note, actually, something I wanted to signpost here what Doug said. And I think, again, I want to say this is why it's so important. If your CPA and financial advisor do not have a relationship, it's a problem. What Doug mentioned was a wash sale. He said they sold Coca-Cola and bought Pepsi. If they would have sold Coca-Cola and then rebought Coca-Cola, then they wouldn't have gotten that they wouldn't have been able to take that loss. So I mean that's.
I don't think Doug said there was a wash rule. I think they sold Coca-Cola and they bought Pepsi.
Well, okay,
correct,
right,
correct.
Yeah,
so
they didn't do the wash,
right? So the portfolio stayed intact.
No, that's what I'm saying. That's what I'm saying.
Right.
That's important stuff. That's high level. That's high level tax efficient investment management. That's good stuff right there.
Right. What Erik was saying before I cut him off is you can't sell something for a loss and buy it back within 30 days. You have to wait 31 days. Otherwise, the loss isn't allowed.
But yeah, that's
nor can you protect the loss with options.
And
there's special tax codes you have to be aware of.
Rich, any final thoughts in terms of like that collaboration and what maybe as someone who's been on both sides of the business as a tax preparer as well as a financial planner, maybe let's take one or two quick things that you could tell us.
Well, I'll share a story with a client. I had a client, single lady. She had a full-time job and she was coaching a sport for a high school, and she had rental properties. And every year, I didn't do her investments. Every year I was doing her tax return, and we were able to project the estimates because she had rental losses every year, and she would take the loss. Well, that year, her investment advisor took a lot of capital gains. The mutual funds paid a lot of capital gains. And Doug, you can explain what happens when you make too much and you get phased out with rental losses.
Well, there's a magic number of $150,000. And if you trigger that number as a married filing jointly couple, you can no longer take your passive losses on rental properties. They are carried forward until your income dips below the limit or you sell the asset. And for those who have rental properties thinking they can offset ordinary income or capital income, investment income with these passive losses, you're going to be in for a rude awakening when you have your taxes done.
Yep. So this lady, she not only had to pay the tax on the capital gains, she had to pay more tax because our estimates were projected lower. We didn't know about this. And she learned what it's like to call the 1-800, whatever, 1040 number for the IRS and set up a loan payment to pay that tax liability.
Yeah, it's amazing.
So that wasn't something, that wasn't good news. And that was something that really taught me during tax preparation, that working with your investment. And that's what I said to her. I go, in the future, if she's going to take capital gains, she needs to let me know. And we talked, and it was a learning lesson, probably not just for the client, but for that investment advisor too.
Yeah,
I don't think.
Go ahead, Rich.
Most investment of people don't realize most people managing investments are not financial planners. There's financial planners, and then there's investment advisors. Mm-hmm. Some financial planners are also investment advisors, but sometimes you just hire someone to manage your money. Yeah. They're not there to give you strategies on distribution or tax efficiency and things like that.
Yeah, they're not.
So you got to be careful on what you hire, who you hired and what they're capable of doing.
Yeah. Doug, there's a lot of magic numbers that y'all need to remember. Do you have like just charts, and is your office just full of charts and tables with especially post COVID? My goodness, all the numbers they keep, man, it makes me dizzy.
I can't remember them all. I have to look them up on occasion because there's just so many to try and memorize. There's those 100 items that come about every day that are just burned into your brain, but yeah, you can't remember everything.
And I think that's key. I think that's why it's key that doing finances with a team, especially if you have high income, especially if you have high net worth, if you don't have a team, then you're probably missing out on some money, some credit, some investment efficiency somewhere along the way. All right, so I think we're coming to an end here. What we like to do on our show, guys, is just kind of give a quick kind of closing thought. Just leave us with maybe like a summary, something that was said on the call that was impactful, or just a closing thought. So, Rich, let's start with Doug.
Okay, so I'm going to piggyback on something that Richard had said, and that is a lot of times when you hire someone to prepare your taxes, that's all you're having them do. And that is they gather the information, they fill out the forms, you're getting a refund or you owe a balance due, and there you go. But I like to look at it from a different perspective. And I use the old adage that those who fail to plan to fail. So I'm a huge advocate and passionate about planning in the standpoint that, yes, I have to fill out the taxes and tell you what the results are. But if whatever the results are, I want to explain to you how the results came to be. And I want to know what's going to happen in the next 12 months and the future after that. Because if there are things that we need to do to mitigate a tax situation or structure something in a certain way that's more favorable, we want to do that now than a year from now when we're looking back in the past.
That's good stuff. Rich, what about you?
So I'm going to go in a different direction. I think when you become a financial advisor, you become engaged personally with your clients. You want to see them successful. You want to see them meet their goals, and you want to see them do it the right way without making a lot of mistakes. So what I'm going to say is anyone who's listening to this podcast, reach out to Erik, Xavier. I'm sure they're going to give you a complimentary call. Give them some information about yourself. Let them see if they can help you with tax projections, collaborating with your your accountant, or maybe just a second opinion. Maybe you have an investment advisor and you want a second opinion. It can't hurt. I know they have the same feelings on helping people. I mean, not only do they help clients, they help their community with education, charitable work. Reach out to them. If you're local in New Jersey, sorry guys, reach out to me. Doug and I would be more than happy to look at your tax return, analyze it. I'd be more than happy to look at your investments to see the tax efficiency on it or how the performance doing, the risk. It can't hurt. Take that first step, take some responsibility. Even if you think you're happy with what you have, get a free second opinion. It's your retirement we're talking about. Unless you want to go to McDonald's in the morning and look at the seniors working there. Trust me, they didn't plan for that. They didn't say, gee, I want to live paycheck by paycheck, so I'm motivated to go to work and keep my mouth shut and not yell at my boss. They're there because they didn't plan properly. They didn't have that opportunity, or maybe they had unexpected expenses with their kids. Let's try to, I know me, I want to help people to meet their goals. It's rewarding. It's not in this business, it's not always about what we make. It's about seeing the results. It's being invited to the client's daughter's wedding because we remember when they were a little kid and we helped them save for college. And then I hate to say, I mean, I've been pallbearers for clients. It's, you become emotionally attached to their families. So reach out to these guys. They're just like me. If you're local to New Jersey, call me, or Pennsylvania, call me. Love to talk to you. No obligation.
Maybe we're not just like you. I mean, that's...
Well, you have as much hair as me. Xavier has more hair.
Yeah, I have more hair than both of you guys. I'm going to leave you guys with a comment as well. Erik, hold that bank up for me again.
That bank, my little bank, my empty bank.
Your piggy
You
bank.
gonna make fun of me for not having any money?
No, absolutely not. I love this idea, and I think this is a piece that I would love to see people begin to implement into their lives. As you're raising your children, get them into the habit of saving money, and knowing where they're saving their money and what the compound interest. What will that money do for them over time? For those who are just out of college and begin working, reach out to a financial planner. Begin creating a strategy, a plan for yourself. That is the most powerful thing that you can do at an early age.
Yeah, good stuff here. So I want to signpost a couple things here that Doug said. Number one, multiple buckets for investments. I love that idea, Doug. I talk about that all the time. I talk short-term, mid-term, and long-term accounts. And those are all different buckets to hold money, from savings to long-term investments. And then I love what you said. It's always a good idea to save. Doesn't matter. The amount of money you have in the future is going to be determined. The biggest determining factor of how much money you have in the future. Yeah, taxes are important. Yeah, investment returns important, but it's your savings rate. How much you save will be the biggest factor in how much you have in the future. So, y'all, thanks for listening. I want to thank Doug and Rich for joining us again. Rich has his own podcast, Financial Matters, with Richard Oring. We'll put the link to that in the show notes. So give him a follow. Yeah. So if you want to, we'll put Doug's information, Rich's information, our information in the show notes. So feel free to reach out to any of us. If you like what you hear here, if you like what you're hearing here on the Stuff About Money show, please give us a follow on wherever you listen to your podcast. Y'all, thanks for listening.
Thank you. This was fun, guys.
Thanks, guys.
Thank you.
Great.